Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So I know that velocity banking is a very popular topic, but I think it's somewhat misunderstood because people think it's a much more complicated concept than it really is in my experience. Because you only have to do a few things, right? Now, if you have no idea what velocity banking is, you might want to click the link below to Velocity Banking 101 and come back here. But in this video, I'm going to just show you how easy it is to create your own spreadsheet to do velocity banking. In order to do velocity banking, you only need two things, right? So the first thing you need is a budget. Okay, so let me go ahead and let's do this. Make that big. Budget, make that red. And the second thing you need is a line of credit as an operating account. Okay, so this is instead of your checking and savings as your main operating account for people doing velocity banking, it's going to be your line of credit. And these are the only two things that you need. And if you know how to do that, you're good, right? So, what is the whole point of the budget? The whole point of the budget is to make sure that we figure out which debts we're going to pay off, and the more debts we pay off, the more cash flow we get. And what is the point of the line of credit? We're going to put our entire paycheck in there and then use our cash flow to pay off the line of credit to zero and then keep paying off debts until we rinse and repeat and we're good, right? So let's go ahead and do that, right? So let me go ahead and move this over. And what we're going to do is we're going to write a column for two budgets. One is for the average American, right? So average American, okay? And let's go ahead and bold and highlight this and make that a little bit bigger. And then the second one, we're going to call that velocity banking. And you'll see the difference between how we engage with the banking system based on these two columns. Now, what's our income? Now, this is going to vary and it's going to depend on your personal situation, right? Now, I know that banks do not like to lend money to people who need it, right? So if you have a lot more money, you're probably going to have a lot more debt because banks don't lend you money when you need it. And their whole goal is that if you have a lot of money, they're going to make loans and even lines of credit, lend lines of credit to you in the hopes that you just don't pay it off quickly. But let's just assume for this person, it's a $5,000 income. And let me actually just do this, $5,000. And I gotta make the fonts a little bit bigger. So let's just do 14. I'll do 14 on this. And let's do currency. And again, I'm doing everything from scratch, right? So let's do currency. Okay. Why is it giving me where is the English? American United States. Okay, there we go. Okay. $5,000 of income, right? And then we're going to track how much our expenses are, right? So let's go ahead. Actually, I'm going to copy and paste this so that we keep the formatting. Expenses, okay. And then we're going to make the expenses into red. If you don't know how to copy and paste, if you're using Windows, it's Control C, and pasting is Control V, right? And what are our expenses? We don't know, and that's going to be variable, but let's just assume it's 3,000, right? And then what's left over in our checking and savings is just going to be checking and savings. Let me just do that. Checking savings. And we'll make that a neutral blue. Okay. It's going to be whatever's left over, right? So B2 minus B. So if you want to do a formula, you just do equals B2 minus B3. Okay? Oh boy. I got to make this all 14. So I'm going to go ahead and do that. 14. 14. Okay. So now this is really standard, right? So now what we have to do is we're going to come up with an expense breakdown, right? Expense breakdown, okay? And like I said, the expense breakdown needs to list every single debt as its own line item. So let's go ahead and do that. So loan one, loan two, maybe you could put a credit card in there. I don't know. But why don't we just do this? Loan one, loan two, and then your rent, and then other. Food, whoopsie, other, food, gas, insurance, etc. Right? And then let's go ahead and make this a little bit bigger. I gotta make them all 14, right? All right, so now that we've done that, let's also write the terms of our loan. So if you have any debts that you have, just write them down here. So again, I always like to use these figures: student loan, 13K, no, 10K, 6% interest, and $400, right? 400 a month. And then we'll do an auto loan that's similar to that, 13K, 6%, 600 a month. And then we just have to make sure that all these expenses equal this. Actually, I gotta put auto loan right here. But I don't know if you've ever seen those student loans where they get the federal loan, the private loan, and then they have like two or three of them. I don't know if you've seen those, but usually you just don't have one student loan. You get different types of loans, but it's okay. All right, so now what we have to do is just write the numbers, and let me just do this to make the formatting easier. So now this one is 400, this one is 600, this one is, we'll say 1,000, and then this is 1,000, right? And so what you do, if you want to just sum it up mathematically, instead of just writing the number manually, do equals sum B7 to B, whatever the line is for the expenses, B7 to B10, right? And that's it, right? So now what we're going to do is we're going to just pay off these two loans using our line of credit, which is going to be our operating account. So what's a line of credit? All it is a financial tool where you could borrow money, pay back, and use it over and over again. So if you have a credit card, that's a line of credit, right? But some lines of credit are have more advantages than others. So a personal line of credit is a little bit more advantageous than, let's say, a credit card because you can pay anything with a personal line of credit. All you're doing is dumping cash from the line of credit to your checking account. Whereas a credit card, you can't pay a credit card with another credit card, right? You can't do that. Unless you do a balance transfer, which has a 3% fee. Yeah, you cannot do that. And you can't pay a loan with the credit card unless you're doing cash advances or plastique. And again, if you're going to use plastique, hopefully you'll get one that has you'll be able to make charges that has cash back, so it's almost like a wash, so you're almost not paying the fee, right? But again, so budget, we accomplished that, right? So that's done. So done. And then line of credit is our main operating account, so let's just do this. All right, so now what we have to do is just write certain things about our main operating account. And let me go ahead and do this. Okay, so we have to write the interest rate, right? What else? And these are just standard things you find on a credit card, credit limit, and then we have the balance, and then we have the interest paid, and we're also going to have the month, right? So the month, okay? All right, so now what's the line of credit that you're going to get? It's the one that the bank's offering you, and I personally have over $220,000 in lines of credit or in credit limits for lines of credit. Um, but you only need one line of credit, right? You want the line of credit that gives you the highest limit and the lowest interest rates. And that's usually going to be a home equity line of credit. But let's just say for now that we have a 15%, right? Whoopsie, 15% personal line of credit. And actually, let me do this. Let me move this out of the way. Okay. So 15% personal line of credit, and let me make the font better too. Font 14. Okay. And let's say we have a credit limit. Again, the credit limit can vary. My personal line of credit has a credit limit of $15,000, and my home equity line of credit has a $50,000 limit. So whatever you can get will just depend on you, right? And as I said before, banks will only lend you money when you don't need it. So you want to make sure you do all of this before you ever need it, right? Build a foundation, firm financial foundation. So when there's cracks, when there's negative cash flow, um, you're going to use the credit line to essentially save you to get through month to month, which is why these types of products exist. Okay, so now let's just assume we have a $25,000. So let me just do this. $25,000 line of credit. Okay. Actually, let me format this correctly. Sorry. All right. So $25,000. And this is going to be month zero. So first month we do is month zero. Okay. And so let's ask ourselves this question. So this is done. The line of credit is now our main operating account, and then we're going to see how velocity banking fits into this context. So again, our income is exactly the same, right? And the thing is that we're going to put checking and savings exactly to zero, okay? Right? And so the whole idea is we put our entire paycheck into this line of credit, take it out, take out our expenses, and then have our cash flow pay down our line of credit using velocity banking. Okay. Now, this is a very simplified explanation. There's a little bit more that goes into it, um, but it's very simplified what I'm saying. Okay. So now we have to ask ourselves, how do we pay off this $23,000 of debt under 1 year using this situation without really changing your lifestyle, right? And the answer is just move these debts to the line of credit. Okay. So we go over why we would move these loans to the line of credit. Sometimes you have like 10 debts. It's like, okay, which debts do you move to the line of credit? We go over that in other videos, but I'm just doing a very simplified explanation of all of this. So let me go ahead and make sure it's formatted correctly. Number format, currency, and where is United States English? Okay. All right. So United States English. So now 23,000, right? All right, cool. So now I'm gonna go ahead and delete that. All right. So now what we're gonna do is, since we have paid off the student loan, again, 23 grand, if you see right here and right here, this is gonna go to zero, right? Ugh, I don't like this font. I'm gonna do this again. Okay. So now this is zero, okay, and zero, but our rent and all the other good stuff is still the same, right? But let me go ahead and copy this formula. Look at this. Our expenses magically went from 3,000 to 2,000, right? Look at that. Isn't that insane? And again, the reason why we can do that is because when we put our entire paycheck into this line of credit, the minimum monthly payment is satisfied. So essentially it doesn't matter. And we're going to minimize the interest, okay? Because the interest is calculated by the average daily balance. All right, so now what we have to do, and let me just put cash flow right here. Ugh, I did it again. Let me actually give a little bit of breather room. So I can put cash flow right here. And cash flow will just be income minus expenses. So it's going to be 3,000, okay? And so what's going to happen is that every single month, this balance is going to go approximately down by 3,000. Okay, so the way that we do that is actually we take sum up these two and then minus it by our cash flow. Now in month zero, we don't have any interest that's going to be paid, because the interest is only required to be paid after when the first statement is generated. So it's going to be generated on month one, but we'll just do this. So what we do is I2 plus J2, right, minus 3000 minus 3000, right? And the way that we calculate interest is by calculating with the average daily balance. So what we can do as a way to estimate it is to average these two numbers, right? I'm going to average them, and then I'm going to multiply it by the interest rate. So multiplication times 0.15. Okay? Not only that, you have to divide by 12. All right? So 12. Because this interest rate is actually the annual interest rate, and you just divide by 12 to get it. Okay? So now what we do is now we just copy and paste these formulas and we're good. Right? Bam, 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 bam. Oh, I always do this. I go too fast. All right. So I'm going to go ahead and copy and paste. If you don't know how to copy and paste, it's Control C to copy and then Control V to paste. Okay? And then whenever you see a negative number, that's when you just either, unless you have extra debt, or you just keep going and move the debt to the line of credit. But really, if this is the final one, then you just put this to 0. Okay? And let's see how long it took. So after all this, it only took us about 9 months. And let's see how much interest we paid. So we sum it up, and we only paid about $1,000 of interest. I think it took us about 8 months, but then there's that extra month where we have to pay the final month's worth of interest, right? But again, look how simple that was. Now, how many people do you know who have $23,000 and can pay it off in a year in a loan? Most people cannot. And even if they had these checking and savings, guess what? If you have checking and savings and you have a debt that's has maybe 6% or even worse, credit card that's at 30% interest, right? You losing out because the most that the checking and savings is going to get is probably 0.0001%. Although these days I think I have seen 4% savings in random places. Okay, so I might be wrong about that, but just in general, you you know you're it's much better to pay off the debt, right? Pay it off, then just putting something in savings and then just keeping making the what I would call the quote the minimum payments, right? The minimum payments, similar to a credit card. You don't want to put the minimum payments. You want to put your entire paycheck and then use your cash flow to pay it down, and then bam. So these are our results. So let's just do this. So results, and let me just do this. Results. So this will be this and is the amount that we paid, and then we do 9 months, and then we're good to go, right? Look how easy that was. Budget, line of credit, you just apply these formulas, right? So average daily balance, previous month's balance and interest paid minus your cash flow, right? And then this goes to 0, and then we're good. All right, so this is Crane Atlanta Mentorship doing another review for you of how to create an easy Excel spreadsheet. You could do this in your spare time, and just try it, and you'll have a better understanding of how this works. Okay, not that hard. All right. Also, if you're interested in joining our group, go ahead and click the link to the Google form below. And other than that, what day is today? Happy 3rd. We're at 3rd of January? No way. Oh, well, yeah. It's past midnight on the East Coast. Okay, great. So now we're in the 3rd of January. So happy Tuesday, Wednesday, wherever you are. Have a great day, and we will speak soon.